Well, hi traders, as we turn the page on 2024 and we look into Q1 of next year and ask ourselves, what will it look like in terms of volatility, range expansion or compression, and ultimately how will our trading environment shape up as we go through the new quarter? There's a couple of things for this year that really have sprung to mind. The first one being the exceptional returns we've seen on a cross-asset basis, certainly in US equity markets, where the Nasdaq and the S&P have worked tremendously well throughout the year. Certainly growth as a factor has been very well traded, and certainly banks have done very nicely as well. In commodity markets, gold's up nearly 30% year to date, trading just shy of 2,800, and certainly in the crypto space, we've seen big moves playing through both on a nominal and on a volatility adjusted basis, and big returns certainly in Doge and Ripple and Bitcoin really spring to mind there as well. The second factor is that we have seen consistently low volatility across asset classes throughout the year, with the exception obviously of the period in early August where we saw the volatility spike playing through. But we have seen the VIX throughout this year averaging 15.4%, which is relatively low compared to the 5-year average of 21.3%. We've seen consistent all-time highs coming through. The biggest drawdown we've seen in the S&P was about 9%, and that lasted about 4 days mid-year. We've seen 3 occurrences through the year where the S&P has closed down 2% or more on the day, which is pretty remarkable. We can also see volatility on the average daily high-low ranges we've seen on a cross-asset basis. And we average it out throughout the year. You can see that's significantly lower than where we've been over the last 5 years. So it's not just on a close-to-close basis, but volatility, if we're looking at ranges, has been lower as well. Now, there's a number of factors behind this. We can say that the Fed put's been in markets. The Fed have been cutting rates and had a commitment to do what it takes to stave off any fragility in the labour market. G10 central banks largely have been all cutting and taking policy out of a restrictive setting. Geopolitical issues have been fairly short-lived, and no one's ever really been too concerned about an energy shock playing through. And US data as well has not just been resilient, but it's been wholly impressive. And there's a number of reasons that we've seen low volatility. The question then is, will we see high volatility playing in Q1 of next year? And I believe there's a good chance it will. Now, as we look into Q1, there's a few factors that are really springing to mind. And we do need to remember that volatility is so important for traders to consider. Higher volatility and range expansion does lead to changes in the underlying liquidity, which can change the cost to trade. You can see one's emotional state being influenced by volatility. We can see lower hold times and higher frequency of trades in changes in volatility. And there's certain strategies which work better in a higher volatility and lower volatility regime as well. So it's really important to consider that. Now, the first factor, of course, is the fact that throughout 2024, we've seen such a strong performance in the likes of the S&P and the Nasdaq that we've got to a point where valuations are very stretched and multi-year highs. Certainly, we look at the equity risk premium in the S&P, we can see it trading at the lowest level since 2002. Of course, now positioning in S&P and Nasdaq futures has become so saturated and rich that there really isn't much of a wriggle room or cushion against any kind of negative news. And as we go into the refresh of 2025, a lot of the active managers who've built up unwanted positions, they've had to chase performance on what's working, may look to offload some of those positions in the new year as well. So there's really not much cushion against any kind of negativity. Now, if you have a look at seasonality, in Q1, if we look at the blended returns of the VIX over the last 15 years, you can see in the chart here that the VIX has done very nicely and seen higher volatility on average as we've gone through the Q1 period. And the same factor is true of gold as well. We can see 1 week implied volatility in gold pushing higher on a consistent basis over the last 10 to 15 years as well in Q1. And that same thematic is true of FX markets. So from a seasonal perspective, volatility does typically rise in Q1 as well. Now, of course, we're going to a point where from January the 20th, we're going to see tariffs being implemented on a number of nations. They're going to look pretty spicy and pretty ugly, to be fair. And I think the concerns around what they look like ultimately and the news flow where obviously Donald Trump's going to be looking to come back to his electorate, to his voters and say, I'm winning this. I've got a hardball situation, but I'm fighting for your rights. It's going to look pretty ugly. Obviously, what happens behind the scenes could be very different. But I think tariff risk is something that necessarily might be underpriced and could cause some anxiety playing through. We're looking at US data as we go through Q1. Of course, if we were to see any fragility in the labour market, higher unemployment, that would be a negative for risk, although that would obviously bring the Fed back into play and suggest we're going to see more rate cuts playing through. But it's inflation that I think we've got to keep our eye on. If we were to see any kind of rise in inflation expectations or CPI or PCE was to move higher, and we were to see the 10-year Treasury move through 450 and look like it was going to go to 5% because of right tail risks, I think that would be a big negative for the market. So it's something that we are watching very closely. But if we were to see a cooling of growth dynamics and sticky inflation continue, that modestly sort of stagflationary environment could be a negative for a market with rich valuations playing through. And also there's a camp out there that suggests that perhaps the Fed are done cutting rates coming forward. So people may start questioning the Fed put in that situation as well. We also think that we're going to see higher volatility playing in Chinese assets as we go into the NPC meeting in March. So certainly volatility is something that needs to be on the radar. Are we going to get it in Q1? It feels to me that that's going to be the case, and we're going to see a change in our trading environment. So trade it with Pepperstone.